Talk Money to Me is a financial podcast produced by TransGlobal. All opinions expressed by the hosts and guests are solely their own opinions and do not reflect the opinion of TransGlobal. This podcast is for educational purposes only and should not be relied upon as basis for investment decisions.
Hey everybody, welcome to Talk Money to Me, where we talk about money and how it affects you. I'm your co-host Jonathan, and I know a little bit about finance. Unfortunately, today, Tracy is unavailable to record, but we still have two wonderful guests with us today. I'll go ahead and let them introduce themselves.
Hi, everybody. This is Walt. I work in financial services.
And my name is Oriana, and I am the mortgage loan officer.
Today, we're going to be talking about something that I think spans generations, and that is the idea of college and college funding. Everyone understands that college can be pricey. You need to be able to have a lot of money to spend. I was wondering if there was some sort of, idea or understanding of how the idea of college funding became a thing that people started to actively prepare for.
I have two boys. They're still young. They're 11 and 9 right now, but I worry about college like many other parents because I understand that here in this country, college tuition can be quite expensive. So I think for a lot of folks, who have young kids like me, we really begin to think about saving for college fund because we know it's going to be a huge expense, when we get there.
Yeah, I have two boys. They're done with college right now. And yeah, we started saving. We had the 529 accounts for both the boys, and we saved a little bit. My first son didn't need any loans, luckily. My second son, after the first year, he went on a scholarship to a small private school in Chicago. And after the first year, he quit swimming because he was on a swimming scholarship. And after that, it was the student loans. So yes, I have one of each.
Even though some of our listeners might not have kids yet, we do have people who decide to go to college later on in life or just want to get that knowledge and education as early as possible so that they can be ready if that becomes a lifestyle choice for them. What's one of the most common options that are available?
I know for some folks who are really, really smart when it comes to investment in stocks, in mutual funds. So I think that's one of the first options that people think about. Like while their kids are still young, they make some money, high risks, high rewards. But the thing about this is that people need to understand that all the gains that they get from investing into these kind of products is that there's no tax advantage. All capital gains are taxable. And there's going to be fees as well. But one major concern when it comes to this kind of way of saving is that it's going to affect your financial aid, when the kids are ready to apply for it. Now, Oriana, like your kids, when they were like applying for schools, did they apply for financial aids?
They tried, but we didn't qualify.
So then if we wanted to see if we could find an option where maybe that's not as big of an issue, what's another option that we could have?
The second type is called the custodial account. Some people might want to start investing for their kids, using their kid's name. It's called the Uniform Gift Act to Minors Act, which is, abbreviated as UGMA or UTMA, which is Uniform Transfer to Minors Act. And by doing that, they can open an account for the kids. There are certain tax treatments or tax benefits for opening an account. So for the UGMA, UTMA, the first $1,100 into the account is tax-free. Okay, and then earning between $1,100 to $2,200 is based on the children's tax rate is only 10%.
Are all children just at a 10% tax rate, or does it actually change? Like if you're 10 years old, it's all
because they don't have any income.
Okay.
Yeah, so a lot of our income tax is based on the income bracket.
All kids under 18.
All
right?
kids under 18, yeah.
Okay.
Exactly.
But once you hit 18 proper, that's when you're charged at a different tax rate.
Yeah. So for those, who's looking to UGMA, the first $1,100 is tax free, between $1,100 to $2,200 is 10% rate. But after earning over $2,200, all the tax rate is going to be based on the parent's income bracket.
Well, They say that a penny saved is a penny earned. And if I've learned nothing else from elementary school, at least I know one idiom. So then what kind of costs would be associated with a UGMA account?
Yeah, I think one of the reasons why a lot of people are not really looking into this, and most people that that I know, they're looking to 529, like Oriana and many of my friends, is that UGMA is a custodial account. So you kind of look after the account, when they're still a child. But once they turn 18, all the money belongs to them. So I think, it's just one of those things that once they turn 18, even though you had the intention of saving this for the college fund, once they turn 18, the money belongs to them. They can go buy a car and not go to college, So it's out of your control once they turn 18. Okay. And then plus, this thing also is counted towards as part of your asset when you apply for financial aid as well.
I see. So even though you do save a little bit on taxes, you don't have that kind of assurance that the money will be used properly, and it still falls into having that weakness of having it affect the amount of federal aid that you can get. Oriana, you had talked about how for your children you had opened up 529 accounts.
Yes.
So I was wondering, what was it about the 529 account that made you decide to go for it?
Well, my mom worked at Cathay Bank, and it was easy. She wanted us to open the 529, so we agreed. And actually, it was a good thing because, we put money in there and we saved it for their college fund, and it was a blessing.
With the 529 account, what are some of the details that are part of it that sort of set it aside from the first two options that we discussed?
Yeah, I think when we are going from one option to the next, I think everything kind of upgrades a little bit once we go from one to the next option. It's all tax-free when you use the money to pay for your kids' college. You don't have to pay for any.
I didn't have to pay for anything.
And also, if you have really rich family members, who want to give you money, to pay for tuition, using a 529 is actually better than just simply gifting the money, to the kid, because above $15,000 per year, you would have to pay for gift tax, right? But if you were to put the money into a 529 for the kid or for your grandkid, then there's no tax issues, because they can put at one time up to $75,000. Now, Oriana, did you feel like when you were opening an account or using an account, there are some limitations that you experienced?
Yeah. For the fact that I couldn't take it out and buy a car. If my son needed a car, like in Chicago, he needed a car. And I couldn't just take out that money and buy a car. That had to come from my pocket.
But you're talking about the limitation in the sense that it's not as free when it comes to the purpose of the money. It has to be only tuition-based.
Only tuition based.
Yes, only tuition based. Yeah. And I think that is one of the limitations when it comes to 529.
So kind of like where with the UGMA account, you have no control what happens to the money after the child turns 18. With the 529, you have extremely limited control.
Let me ask you this. Let's say your son graduates and you don't use all the money. Then what happens to that account?
You can pass it to the next relative, like your child's cousin. Or maybe your nephew or your niece. Okay. But the moment you tap into the account, you use it for non-educational purpose, is 10% penalty right there. Not only is the fund kind of limited to education only, the investment options, for 529 is very limited. And the portfolio, the rate of return is going to be really, really conservative. One more thing is that 529 is going to affect a financial aid application as well. I think the best way to save for college fund at this moment is through indexed universal life insurance. And a lot of people, when they think about life insurance, life insurance, why am I using life insurance to save for my kids' college? But indexed universal life insurance is a little bit different. The money that you put it into this account, it has a downside protection. And the potential growth, the average rate of return is about 7 to 8%. And if you let it sit for quite some time, it can actually, with compound effect, it can actually be a pretty substantial growth. And then the moment you begin to tap into your cash value from the life insurance policy, you can use it as a loan, which is going to be tax-free. But you can even use it to buy your son a car, like for, Oriana's example, it's not limited to education only. When it comes to IUL, one thing that you need to know is that you need to buy it for yourself, not for your kid, because that way you can put more money, in the growth. But the thing is, one of the disadvantages is that if you're too sick, or if your spouse, or the parents is too sick, the premium can be pretty high.
That makes sense because, since it's inherently at its core a life insurance thing, it needs to be based off of whoever they are doing the health check on. That makes sense to me.
And then the second thing is IUL, like many cash value based life insurance policies, needs time for growth. So it would at least takes about 10 years. So if your kids are too old, if they're in the teens, you're a little bit too late for this. So I think that's another disadvantage. But if your kids are, maybe 5 or 6, this is one of the best, if not the perfect product, for saving for kids' college account. And not to mention the fact that this will not affect financial aid.
Oriana, I know that you have a lot of experience with loans. So the most common thing people associate college with is, unfortunately, student loans. So
Yes.
how do student loans kind of play into this factor? Is it something that people should consider?
Student loans I would use as a last option. There's one more option in between student loans and Walt's financial planning, and that is getting cash out from a refinance out of the house that you own. The benefit is that you have a lower interest rate. It's spanned over 15, 20, or 30 years, and it's a manageable payment plan.
With college funding specifically, is this one of those options where you would just refinance in general, or is this more specific towards the cash refinance?
It'll be a cash out refinance.
Okay.
I have a lot of parents coming to me a lot of times after the kids have student loans and they're paying these enormous payments. They come to me and they think of it afterwards. But, better late than never. If your son or daughter is going to college for 4 years and maybe getting their doctorate degree, which a lot of my colleagues, their kids do that. They want to be doctors, lawyers, one of those great professions. And then those are costly professions, unfortunately, especially if you're going to go to an Ivy League college or a private college. They're very, very expensive. So they come to me and they just get a lump sum. Either they pay the tuition first or they invest that money and make it grow a little bit, have the kids get the student loans. And when it's because they pay the student loans 6 months after your child graduates. So in that time, they could cash out from their investments and pay off the student loans. That's what a lot of my friends are doing.
If you can, go try to do a refinance on a mortgage that you may have.
Yes.
But then worst case scenario, take the student loan, just be prepared for a very long-term committed relationship to it.
Yes.
We hear the term scholarships thrown out a lot and the term grants thrown out a lot. What are the differences, if any, between these two, a grant and a scholarship?
Grants are based on financial need, and scholarships are awarded by merit.
Okay. So then with a grant, that would be like FAFSA. FAFSA is based off of need, and that's
Yes.
why. And then with the scholarship, it's just were you a good student? Were you, very active in a sport? I have heard that there are some teen beauty pageants out there that give you a scholarship as well. So
Yes.
good looks pay off, ladies and gentlemen. I think what would be kind of fun to close our episode with would be to kind of take turns sharing what was the college tuition like for you guys, because we are all aware that it's just going up and up.
You want me to go first?
Sure.
Okay. I went to a small private college, Cal Baptist University in Riverside. You're looking probably, I graduated in 85. And I think tuition at that time with dorming was under $15,000 a year.
Okay, so I grew up in Canada, so I went to a public school. I lived at my parents' house when I was studying there. I went there. I graduated in 2001, and I remember the tuition was around 8,000 Canadian for the 4 years.
For me, I was in school from 2008 to 2011. Even with financial aid, I went to UC Irvine, and tuition for a year at that time came out to $12,000. So to me, that's really shocking that with help, my costs per year were very, very close to like a private school's cost back in the day.
Well, let me hold up a little bit. So you said 12,000. That's after FAFSA?
That's after FAFSA.
Oh, jeez.
Yeah.
Wow.
So
Wow.
to all of you listeners out there who have graduated from college, be I guess somewhat thankful that you got it cheaper, despite how expensive it was, cheaper at your time of living. And for those of you who are preparing for kids, we salute you. And with that, we'll go ahead and draw this episode to a close. Thank you so much to our guests for joining us today. We'll catch you at the next one. Bye.